Disney shares falling. It was a mixed quarter. The company did beat on the bottom line. It posted a slight revenue miss. Entertainment unit, by the way, helped by streaming growth continuing to increase there. Let's talk to Michael Morris, Guggenheim Partners analyst. Does have a buy rating, $140 price target. Michael, what do you make of the quarter? I mean, we're now talking sort of about a back-end loaded year, and I guess what? Investors don't want to wait and see if they actually do deliver what they say?
I think that's part of it. I think the stock is fine and the performance and the outlook is fine. It wasn't necessarily better than what we thought. They'd already given us guidance for earnings growth in 26 and 27. They reiterated that. And so you could kind of take the pieces apart a little bit and decide whether you like it or not. And I do agree with what you just mentioned, the sort of back half loading of the performance. That can be a problem coming out of an earnings call. The other things I just keep in mind is there is uncertainty about the two biggest parts of the business. When I see pressure on the stock, generally, it's either because people are concerned about the experiences segment and what's happening in the consumer world, or they're concerned about that entertainment segment. And really that's about, is the direct-to-consumer business growing fast enough to offset the declines in the media business? And I think on both fronts, they have some things to prove this year.
Well, tell me what those are to prove then.
Absolutely. Well, let's just start with the entertainment business, right? This is really about the handoff from the traditional linear business that we all know about that has cord cutting and declines into this direct-to-consumer world that now has an ESPN product in addition to the Disney Plus product that was already in the market. A big part of Disney's strategy to grow that direct-to-consumer service is this bundling concept where you pay a lower price and you get all of their services, Disney, now ESPN, Hulu in one product. And there have been early signs that say the bundling approach does work. It gives them longer subscription life, lower churn, some ability to just be stickier in terms of day-to-day engagement. Those are all positives, but it's still to be proven, right? This ESPN product is only a couple months old. There's a lot of investment in it, and so we want to see the actual revenue and profit growth starting to accelerate again, and that's what I think they need to show this year.
I mean, they're talking about, what, $10 billion in operating income? So given where you think the stock is going, I would assume you are a believer, ultimately, that they will deliver on the targets they put out there.
That's true. But I would also point out that I think that the stock is simply undervalued. Right now, it trades at about a 25% discount to the market at the low end of their guidance range for the coming year. So I wouldn't say that the stock is reflecting huge expectations for their performance at this point. But I'll also be direct about the fact that the growth at the streaming business, even in isolation without the pressure from the other sides of the business, has not been as robust as we would like to see, has not been as robust as, I hate to say it, Netflix on the top line, despite the fact that it's at an earlier stage in its life cycle. So when we want to put a premium multiple on that segment of the business that should be the highest growth business, we still do have to compare it to other streaming services, and we want to see them do a bit better there.
Yeah, well, we'll keep an eye on that and always appreciate your helping us understand what's going on. The stock, of course, now actually down for the year with this recent move. Michael, thank you.